Okay. Good morning, everyone. As you will be aware, this meeting has been held remote due to COVID restrictions. So I'd just like to let you know that it's live streamed, as the public can't physically be with us. They can view us through the YouTube, Falkirk Council's YouTube channel. Thank you. I'd like to welcome you all to the committee and board meeting this morning, and hopefully we'll have a wee break round about 11 o'clock, but we'll see how we go with the agenda. We've got a couple of guests with us this morning. We've got John Dixon from Hymans, and we've got Scott Jameson, one of our GISP advisors. Thank you. Thanks, guys. So, Tonya, is there any apologies?
Yes, we have apologies from Jennifer Welsh from SIPA, Stan Pearson, who's independent advisor, Andy Douglas from Unison, and Simon Hunt from Scottish Autism.
Thank you. I believe Simon might join us later on due to calendar requirements. Hey, do we have any declarations of interest this morning? Nope. Brilliant. Moving on to the minutes. We've got two sets of minutes this morning. So minute set A. Clarify. Oops. Okay. Any questions?
Agreed.
Nope, agreed. Thanks. And minute B. Agreed. Brilliant. Swiftly moving on this morning to agenda item 4, and that's general governance. And I'll hand over to Debbie. Thanks, Debbie.
Good morning, everyone. Just quiz through the general governance paper this morning. The first thing is the first item on the paper was with regard to the replacement or the rotation of the chair of the board from Simon Hunt to a union member. So I'm delighted to say that Tony Cleary has kindly offered to take over that role from Simon from the end of this month. So thank you, Tony, for that. And we've been in. I don't know, Simon will provide you with a handover, but we will also catch up at the end of the month. So thank you very much for that.
You're welcome.
The second item is the fund merger, and that there's a paper on that next week, so I'm not really going to loiter over that item at this moment in time. The third item is about procurement, and it was just to give an update that along with a kind of usual collaboration with Lothian, we've gone down a couple of routes of procurement. The outcome of one of the procurements is not yet public, but we're quite far down the route of that, and we're at the very beginning of the other one with regard to the custodian. The one that we're close to is the voting and engagement specialist appointment. So hopefully we will be able to share more details fairly soon. Apart from that, the paper touches on the COVID deaths, not really much movement on that. Legislative roundup, also the case, and gives the usual details about the voting on the corporate governance side, and a bit of an update on the SAB, which has appointed a strategic programme manager for a 12-month programme, and they are expected to report back in March 2022. The final item was just really to put out there for the members of both committee and board some training opportunities. So there's a local government association fundamental training programme, which is 3 days, which you can pick and choose from any of the 3 days or go for all 3 days. So if MD's interested in doing that, you can do it virtually this year. Then just let me know, and I've already got one taker. So if MD else wants to join in, there's an item, for example, on climate change on one of the days. So the details are in the appendix. So please just let me know. I've since writing the report, there is another LGC Investment and Pension Summit from the 9th to the 10th of September this year. So I will probably just email that round to everybody. And again, if MD is interested in taking that opportunity, please let me know. Convener, that's everything, unless anyone has any questions.
Any questions? John?
Yes, thank you, Convener. Just a question turning to item 5.1 under procurement, the entry states the intention to procure a specialist firm of engagement advisors. Can you just confirm to me that if this has actually been done and if someone has been appointed?
Councillor Pat, so we've gone through a process, a joint process with Lothian to assess, to tender and assess. So there was an agreement to appoint a specialist, and we are pretty close to appointing. It's just not quite public yet, so I can't say who it is, but is a winner as such. It just needs to be, the final bits of procurement need to be sorted before we can actually say. So there will be an appointment shortly.
Thank you, Debbie. Perhaps I could also ask you under 5.4, when it mentions global custody services, can you just confirm to me who at present is providing this service for Falkirk Pension Fund?
Currently it's Northern Trust.
Thank you.
No problem.
Did I actually read somewhere, and I can't find it, but read somewhere that there's an application to for stock loan lending, or whatever the word is. Has this actually been pursued with Northern Trust?
Not at this time, Councillor Patrick. We are aware it's on the agenda of things to consider, but we haven't brought a paper forward on it yet. It is on the.
Because I'm aware that I am aware that a previous meeting some years ago now, no doubt, this matter was discussed, and at that time we decided not to proceed with that item.
Convener, if I can maybe just interject there with your agreement, when we come to the tail item on the agenda on the GISP, there's specific mention of it there, so perhaps we can develop it further at that point with your agreement.
Yep, that's great, Brian. Is that okay, John?
Yes, thank you very much.
Thank you. Has anyone else got any other questions?
Convener, you're on mute, I think.
Oh joy, that's the first time today. And what time is it? 12 minutes, but it's not even 10:15. Thank you. If no one's got any other questions, we'll note that paper and move on to agenda item 5, and that's with Brian, Investment Strategy Review. Thanks, Brian.
Thank you, Convener. Thank you, and good morning to all. Convener, I think recognising the fund strategy in the normal course of events is the most important decision made by the committee, and of course supported by the board. And that's because of the impact on investment performance, funding level, and contribution rates, and also the recognition that not all could make the training event last Friday. So I do suggest we do spend appropriate time on this item this morning. To that end, I'm proposing that we deal with the investment strategy in the following manner, which in large measure does follow the training day course. So firstly, I'll run through the cover report, not in any detail, but just looking to give you an overview. Then John from Hymans will do a deeper dive, and apologies to Councillor Reid for the use of that term, and zero in on the key slides in the appended deck. And finally, Scott, one of the fund's advisors, will look to draw out some key points that you should have regard to in assessing the proposed strategy. So with that, Convener, if I just, as I say, very briefly look to draw out some key elements in the cover report. So the review of the investment strategy flows from the triennial fund valuation, albeit I think going forward there's a question as to whether it should be more integrated with the valuation given the impact on employers' contributions, but that's something for a few years hence. It's been conducted in association with Lothian and Fife, given the joint working with these funds and also significant degree of fund alignment. Now, the strategy aims to balance contribution stability with the need to generate positive real returns to enable us to pay pensions eventually. The approach taken by the actuary, and clearly John will say more about this, is to model various strategies and scenarios and quantify the probability of achieving our stated objectives. Recognising that a strategy which targets higher returns and therefore lower employer contributions will be underpinned with volatility. A core scenario proposition from Hyman's assumes a significant rise in gilt yields, in the technical terms yield reversion, but consistent with the advice from the advisors and the Lothian team, it's viewed as premature to follow this course at this time, and I'm sure Scott will say a little bit more about that later. Just jumping to the outcome of the strategy review, which is set out in section 9 of the report, I think the key thing to note is that we've ended up at a place only slightly changed from our existing position, which perhaps in itself provides some comfort, but plus a change, I suppose. In getting to that outcome, Falkirk was starting from a lower funding level, which gave less scope for us, in any case, to reduce risk and contribution rates. But there may well be scope in the future. But linked to that, a significant point to note is that in potentially setting any triggers we may for such action, this won't be done automatically. It will be placed in a wider context before any such decision was taken. And maybe finally, just to note that there were some minor changes in the policy group definitions, and that's picked up in section 5 of the report. So I'm going to stop there, convener, and with your agreement, hand over to John in the first instance, to be followed by Scott, but John in the first instance, to run through the work that Hyman's did for us to get to a proposed final outcome. Thank you.
Thanks, Brian. Really appreciate that Scott is here this morning, and John, given that we did have the training last week and I know not everyone could attend it, so appreciate the time that they're taking this morning to explain things to those that possibly missed. So just moving on, thanks.
Thank you. Morning, everyone. And thanks for the intro, Brian, as well. So as you've alluded to, this is a kind of 10-minute version of last week's hours presentation. So I'm going to be very brief and perhaps leave some of the detail to be covered in questions as we go through them afterwards. I'm not intending to share the screen and show any of the slides that were in the documentation, but I will if we need be, particularly if there are any particular questions. But I'll flag now that the results pages I'll be referring to later are on pages 42, 43 and 46 of the appendix. So just in case you want to get them ready. As you'll have seen in the papers, we've done some modelling. The proposals in your papers are based, at least in part, on the results of that modelling and the market context, which Scott's going to cover after me. And the important aspect, as Brian's already alluded to in that market context, is a view or a sense of the potential for long-term gilt yields to be any higher than they are today. And we'll come to that. During the valuation process, you agreed contributions based on the chance of achieving a long-term funding target over 20 years. And in the modelling we've done, we've considered the implications of different investment strategies for the fund based on that same 20-year time horizon and using the same underlying model. And that model projects forward the assets of the fund, allowing for returns of different asset classes, how they correlate with each other, the contributions coming in, and obviously the benefits and expenses you're paying out of that asset pool. And then it compares that with the projection of the liabilities, so a long-term projection of future benefits. So we project forward the liabilities, and then we test the potential evolution of the funding level based on that projection of assets and projection of liabilities. And not being very imaginative, we call that an asset liability model. We do that over 5,000 different simulations of the future. So we don't take a view on the future specifically, although the yield point will come to. We do 5,000 different simulations, and they give a distribution of 5,000 different funding levels in each simulation for each simulation. The distribution of the potential outcomes in the future, which shows how well things might go for you, and also shows how resilient the fund is to adversity. And then with that distribution of 5,000 simulations, we can use those 5,000 outcomes to test 3 things within the results. How many of those simulations or scenarios actually achieve your 20-year target, the 100% funded target in 20 years? And that therefore gives you a probability of achieving your goals. So we'll call that probability of success, if you like. We will look at how many of those scenarios are below a funding level at the next valuation, which might put upward pressure on contributions. So the probability that you might have an increase in contributions at the next valuation, or maybe not such a nice phrase, but probability of failure. And for that, we've used a funding level of 65% as the threshold, just so that we can compare different strategies. Now, the number might be 70% or 60%, but it's in that sort of ballpark, and that helps us compare strategies for the chance it could go quite badly over the next 3 years. And then the third measure is, in those bad outcomes, between now and the next valuation, we assess how bad could it be. So how big could the deficit amount be? And the importance of that is that for different strategies, that deficit amount will be different, and it will show you the extra pressure on contributions in monetary terms that you might feel in those worst cases. In the modelling, we've considered a range of investment strategies, some of which are shown in the deck. Our start point is your current target strategy. And we think of strategy in this high level modelling as the allocation to the various policy groups that Brian's touched on. And your target strategy, as we've modelled, is 60% in equity, 20% in real assets, 15% in debt, and 5% in what's now being badged as LDI, which was once called gilt. And I know the proposal is to switch around the allocations to debt and LDI, but I'll touch on that in a minute. So we think of it, we start with your current strategy, but we're also aware that your current allocation is slightly different from your current strategy. So you've got slightly higher allocation to equities, and we'll touch on the difference there as well. As well as the actual position and the target, we've considered a range of lower equity allocations. And then we model those different strategies, as I say, at the policy group level, rather than at the very detailed level of what you're allocating to. There are many features of the models that influence the outcomes, the results that we've shown, but the 3 main ones are as follows. The first one is the starting position, so your initial funding level. Now, it's obvious, but it's important for the conclusions later that the better your start position, the better chance you have of achieving your objectives, and therefore the more flexibility you're going to have in taking action with either your strategy, your contributions, or whatever. I mean, it sounds like a statement of the obvious, but it is an important feature. Secondly, the allocation to equities and the assumption within the model for the expected long-term returns on equities and the risk associated with equity investment, which this is based on long-term historic data and some economic theory, and is pretty standard across most of these models. And then the one that Brian's alluded to, and probably the most well, potentially controversial one, and most important one in some sense, is the long-term expectation for. Sorry? Did someone ask a question?
No, sorry, Councillor Buchanan, can you go on mute, please?
Right. Sorry. The long-term expectation for gilt yields. And let's just touch on how you model, how models tend to deal with gilt yields. So pretty much all models of long-term gilt yields involve a long-term central assumption around which those yields are expected to move. And for each simulation, the gilt yields can be higher than that central assumption or lower than that assumption. And there's a range that's shown in, I think, slide 18 in your deck, just to give you a sense of the range of those yields can be. But it's expected that if yields are materially higher than the central assumption, there's a tendency to revert back down. And if they are materially lower than the central assumption, there's a tendency to revert back up. And that's the yield reversion that Brian mentioned. The key is, therefore, what's the central assumption for long-term gilt yields? And as the covering paper mentions, and we touch on it in the slides, in our core model, we use a central assumption for long-term gilt yields over time, which is higher than the market expects them to be today, but lower than the historical average for long-term gilt yields. However, the implication is that on average, gilt yields are expected to rise, and therefore funding levels would improve just because gilt yields are rising. And as Brian's mentioned, there's a nervousness across the advisors and with us too, that is banking good news from a funding perspective. It's banking an improvement in funding before you've actually experienced it. And the discussion with the GISP, and we talked about last week, was really, let's remove that particular source of profit, if you want to call it that, until we actually see it happen. So given that concern of that is a bit over optimistic, we've also run the results purely on what we call a low yield central assumption. So much more in line with the current market expectations, very slightly higher than current market expected levels. And so that strips out that effect of gilt yields helping it. Having said that, that's a central assumption. Over the 5,000 simulations, there's a wide range of outcomes for those yields, and some of them are above the central assumption, and some of them are below the central assumption, and even negative. And so there is still a wide range of yields shown in the scenarios. I'm going to move on now to the results, and I'm going to focus entirely on the low yield model results. We've shown the core model results just for good order, because that would be our core model approach. But the key results, as I said, are shown on slides 42 and 43, and they show that the probability of achieving 100% funded over 20 years is below 70%, below 2/3. These are thresholds that you've typically used in the valuation when setting contributions. So on that basis, it doesn't encourage any reduction in equity today, which is what Brian talked about. The scope for reducing equity risk within the portfolio is pretty much not there. However, we note that the results are pretty much the same. The probability of success is pretty much the same whether you use the actual allocation with a slightly higher equity exposure or the current strategy, the target strategy with 60%. So you've certainly got scope to move to your target of 60%, but there's not really any more scope today as we see it. Slide 43 shows the difference in deficit risks, and if you were able to reduce the equity allocation by, say, 10%, there's about 100 million difference in the worst outcomes for the deficit of the next valuation. And the importance of that number is that in bad outcomes, that 100 million would be an additional amount that would need to be recovered in contributions over a period of time if the riskier strategy was retained. So the implication of that is it shows why you might want to reduce equity risk if and when it was affordable to do so. Currently, as we've said, we don't think it is. And that brings us to the results on slide 46, which show the impact of a further 10% improvement in funding level. Now, at that point, this is to do with the start point being much better. So if the funding level is 10% better, we see that the probabilities of achieving your long-term targets have improved materially and are now all above 2/3 for the different strategies shown. So what this indicates is as the funding level improves, particularly if you have a year like we've just had, where despite the pandemic, the funding levels improve quite materially, that will offer you a lot more flexibility to take other to adopt other strategies or even look at contributions. And so the ability to reduce equity exposure will be there as funding levels improve. Excuse me, I've got a light that switches off if I don't move enough. So this is what leads to our core conclusion, and this is just coming towards the end, that there's little or no scope to reduce the allocation to equities at this stage, other than to achieve your current target of 60%. And so the proposal that's in front of you, and in fact, the results show that the allocation to debt and LDI policy groups, the results are relatively agnostic to the allocation to debt and LDI, and so the proposed slight change in those allocations are also supported by those results. However, the results have also indicated that with improvements in funding level, it will give a much wider flexibility of movement, both in terms of investment strategy and or contributions. And so that should be used as triggers for discussion about how you best use that flexibility. And that's our the core outcome of the work. I'll just lastly, very quickly touch on climate change and climate risk, because we have done some modelling on some climate scenarios as well. I'd caveat that with saying that climate risk modelling is very much in its infancy within terms of long-term models, and we're already developing a kind of version 2 of what we do, which will be much more advanced. But we've considered 3 different climate scenarios based on government or market responses in attempting to achieve the Paris Agreement or not, or aligning themselves to the Paris Accord or not. In the most optimistic of these, from a climate perspective, the results are very similar to what we've just discussed: a similar expected outcome, a similar scope to de-risk or not. In the more pessimistic outcomes, the physical risks associated with climate change come to the fore and are likely to significantly damage economic and equity growth. And these are much worse in terms of the outcomes for the fund. And so we only have, therefore, a couple of tentative conclusions from acknowledging that this is very early stage modelling. The implications might be that it supports a general desire to reduce the exposure to equity markets if that is affordable to do so. So it supports the other conclusions that we've mentioned, but it also supports a very active ownership approach, engaging with managers and investee companies to encourage them to align their businesses to achieving that Paris Agreement and beyond, because that's good for everyone and certainly good for the fund. And I'll stop there.
Thanks, John. Brian, do you want to add anything at this point, or we just move to questions?
Oh, sorry, questions of John, or do you want me to come in now?
You can come in now, yeah.
Right,
I don't see
sorry.
any questions initially, okay. So yeah. Thanks, Scott.
Okay, morning, folks. Unlike John, I'm going to attempt for the second time this morning to put slides up on the screen because mine, I don't think, are included in the pack that was sent out. And here we go. No, that's my swans. I knew the first time this morning it was luck. Oh, rubbish. Sorry, just 1 minute, folks. I appear to have wrecked this.
You'll get there.
That's a level of optimism I wouldn't personally share, actually. I can't even get the WebEx screen to maximize. Right, I think I'm digging a hole deeper. Right, sorry about that, folks. I'll just talk, and hopefully you can visualize what I'm referring to. In the training session, I was asked to do 2 things. One was to give an overview of market backdrop against which you're looking at reviewing the strategy, and the second was, excuse me, to pick out certain things from John's deck. With regard to the markets, and the guidance I would give is that the world has been changed by COVID, and the financial world has been changed by COVID, but that change was going to happen anyway. COVID has just accelerated it. And the principle, once in a double generation change, has been the movement of both monetary and fiscal policy, so central banks and government spending, onto what might be regarded as full throttle policy settings. In some large part, this was unavoidable in terms of governments joining the game and starting to get the checkbook out, because central banks had done as much as they could in terms of cutting interest rates and printing around the world. And this new era of a policy max setting for both public spending, taxation, and for central banks is something that no one active in financial markets today has seen before, and therefore that challenges the use of historical data in a way that we haven't had to think about for a long time. So there's been a profound change in the grand investment backdrop, and one of the consequences of a policy max setting, as I have described, is that while it's very supportive of the real economy and therefore real economic exposure through equities, etc., the fact that it's on max means that any sense that even that might not be strong enough to stimulate the world economy and lower unemployment and reduce inequality. If you've thrown the kitchen sink at it and it doesn't work, then markets will quite quickly flip from current optimism to downright pessimism. So, and as a consequence, you should anticipate that asset market volatility in the years to come will be higher than we have been used to, even allowing for the deep shock of spring last year. The other thing to think about for the optimists is that, well, what you're worried about, Scott, we've had the end of the financial system in the credit crunch. We've had arguably the end of the world in COVID, and we've had the end of the Eurozone and the Greek crisis. And yet here we are with equity markets at all-time highs. If that doesn't, if those events don't shake market confidence, then perhaps nothing will. And one has to acknowledge that, but I think it's worth remembering that the economic and financial market recoveries from each of those existential threats has been bought at huge cost. The GFC saw base rates go from 4.5 to 0. That's a UK rate, but it's the same everywhere. The Greek crisis saw the Europeans abandon orthodoxy and embrace QE, something thought impossible. The COVID shock has seen governments across the world spend trillions of pounds. We used to worry about billions. Billions are nothing anymore. So they're spending trillions. So the challenge for the optimists who see resilience in equity markets is that there will come a point where there's nothing left to spend. We have thrown the family silver at it. And so the general backdrop, whilst policy-wise supportive of investment, there is a risk that if it doesn't fail, we don't have anything else to do. The result of that will be higher levels of volatility. What I went on to show at the training session was provide a list of various things, plus and minus, that markets and participants have to think about. And in that list, it's always easier to highlight the potential downside risks than it is the upside risk. Sorry, I can't put that up on the screen at the moment. But one of the, actually on both the pluses and the minuses, I had mentioned the same thing, and that was the rise of retail investors, which has been one of the most significant changes in the last couple of years. In part, that reflects, in years gone by, the closure of private pension schemes, and people have had to make provision for themselves. In part, it reflects the support checks, etc., particularly in America, that everybody in the population got as a result of COVID. But the retail investor has kind of embraced market investing in a way, the like of which and a scale of which they have never done before. And that is another factor that accentuates the outlook, exacerbates the outlook for volatility. If the retail flock decides something's going up, then they pile into it en masse, hook, line and sinker. And equally, if they lose despair, if they lose hope, that despair tends to be expressed by everyone at the same time. And unlike you, whereas you might think of a big negative move would be liquidating 5% of your equities, retail investors tend to liquidate 10, 20, 50%. And so these flows are both good and bad, good in the good days and exacerbating downside on the bad days. So overall, the market backdrop I gave was one of supportive policy. Policy wants markets to go higher, wants everyone to be wealthier, wants the pension scheme to have a higher solvency level. But the risk is that they've committed everything to achieve that, and failure is hard for people to imagine at the moment. But from your perspective of needing to grow asset value at the moment to improve your funding level, arguably you're in a bit of a sweet spot where the actuality of policy is very supportive and the risk that it might fail is tomorrow's worry. So there is a sweet spot where markets, although they're currently expensive on many metrics, markets continue to go higher before people begin to cry that the emperor is naked effectively once policy, if it proves to be exhausted. So it's a bit of make hay while the sun shines, and that suits your decision to, or likely decision to maintain your risk weightings at the moment. The next part of what I did was just to pick out various points out of John's work. The first was to remind people at the training session that modelling is not there to give you an answer. The modelling is there to provide a measure of uncertainty. Some, perhaps unkindly, many of the diagrams that Hyman's showed are referred to as funnels of doubt, and that's really what they are. The wider the spread of outcomes, the more uncertain and therefore the outcome would be, and therefore the more cautious you should be. So don't expect the model to give you the answer. It will give you an illustration of what being wrong looks like or could look like. I won't, given I don't have that, can't bring up the chart, I won't talk about the next thing that I mentioned at the session. Just lastly, in two areas. One, there's a lot of talk of risk when you're looking at strategies reviews and for pension funds generally, and it's always important to remember what you might be meaning about risk in a specific context. Most of the time, we tend to think about risk in absolute terms. So if I invest 100, will it fall to 90, and therefore I will have lost money? But in the context of the pension fund as a whole, thinking about assets and liabilities, the threat of losing 10 on your assets as 100 goes to 90 is softened if the value of your liabilities goes from 100 to 89. You're actually ahead. So having this idea, having a clear idea is what you mean by risk, absolute or relative to liabilities, is very important. And I'm often in conversations when people jump between the two seamlessly, and that can be very confusing when you're thinking about risk. For your part, you really shouldn't care if the assets fall to 90 or 50. provided the liabilities suffer more, because that you're there to, the amount of money you've got is irrelevant, provided it funds the claims that you're projected to experience. Lastly, then on bond yields, and John has spent some time this morning drawing out various comments in the paper. The notion, and John alluded to it in effect, the notion that bond yields will rise is not a new one. It's been around in markets for very many years, even before the GFC. And that was based on long-term histories as much as anything else. One thing to remember about a bond, though, it can't really do much more than what is happening at the front end of yield curves. So to be specific, if base rate stays zero, it's very hard for gilt yields to go to 2, 3, 4% if the cash interest rate stays at zero. And therefore to express a cautious view on bonds or gilts, and therefore that you expect a rising yield on bonds or gilts, you have first got to make an argument that base rates are going to rise. Now, central banks have been very clear that base rates may rise sometime, but not any year soon. And even in the US last night, there was some suggestion that the base rate in America would be raised by 0.5%. That's not happening until 2023. So if you've got an anchor at zero, it's very, very difficult for a bond yield 10 years out or whatever to rise by much. But if it does, it probably means that there's a bit of an investor exodus and people are fleeing the country because there's an increased credit premium or default risk associated with, in our case, the UK government, to be extreme. If it looks like this fast and loose monetary and fiscal policy backdrop is going to turn us into Venezuela, there will be a rush for the exits, and that will be manifest in higher bond yields. So you might get the higher bond yields that some hope for, but actually you should be careful what you wish for, because it's only good news if all the other assets don't suffer in tandem. So overall then, we're entering a new era in terms of financial markets. Investing, both short-term and long-term, has to recognize and adjust for that. Markets might be pretty elevated, but we still face myriad risks. Some have changed, some have been there for a long time. And when you're thinking about risk, be very clear about what you mean. I'm sorry about the slides.
Thanks, Scott. You're
Yeah.
still sharing your screen though, so can you turn that off?
Yeah, I fear, well, at least the swans were there.
It's just a blank screen we're seeing.
Oh, wow.
Were the swans black, Scott?
No, they were very pretty swans. I may have to exit the session and rejoin because there's no icon that allows me to maximize anything here. So forgive
Can
me.
you not just click the share again and it'll come off?
I don't even. Oh. You're sharing search. How do I unshare? What a disaster.
Yeah.
Yay, there you go.
I knew it was beginner's luck. I done it first time.
That's a shame. Thanks very much, Scott. And I was just sitting there thinking, to have a crystal ball and to know what the future holds for us. Wouldn't that make life a lot easier?
It'd be boring for us investors, though.
Well, I don't know. I'm quite sure you would throw some doubt into the mixture anyway. Well, I'm a bit of an optimist, me. Some people say we're blind. Anyway, has anyone got any questions, or does anyone want anything further explained this morning? No? Well done, guys. As I've obviously explained it so well that no one has got any questions. We're all totally clear on what we're agreeing to hear this morning. I'd like to refer you back to our recommendations. First off, to note the report. Yep. And secondly, to agree. I think it's item 9.1 to 9.3. So do we agree the recommendation of our strategy?
Agreed.
Agreed.
Yep. Well done. Thank you. And thanks again, guys, for joining us this morning. What time are we at? 10:02. Does anyone want to take a wee break now before we move on to the next agenda item? No? We're all good to go. Okay, moving swiftly on.
And I assume, will we drop off now and leave you to it, or what's
Yes,
the-
that you can. I mean, you're welcome to stay if you wish, but you know, I don't think, Brian, I don't think we need the guys for anything further in the agenda, do we?
We don't need John, but I think Scott could usefully stay on in terms of the market review and indeed the review of the GISP. But thank you, John, very much for your contribution this morning, just to echo the convener's comments.
Right, thanks, everyone.
you.
Good to see you. Right,
Thank
bye.
you.
Yes,
Bye
bye-bye.
Where are we? We've moved on to agenda item 6, and that's the market review. And Bruce, are you going to take this paper? Is Bruce with us?
Sorry, I think Albert's going to take this.
Brilliant.
Thank you.
Thanks,
Okay.
Albert.
Okay, thanks, Bruce, and thanks, Chair. So yes, this paper, an overview of market developments and fund performance to end of March. So starting at paragraph 3.1, just an overview of what how markets performed over the quarter. So the beginning of the year saw mixed returns from asset markets. So investor risk, people didn't know where to go. But gradually, as you know, vaccination rollouts gathered momentum in the early months, then risk assets performed more strongly, and so equity markets actually had a very positive return for the quarter. In contrast, bond yields actually rose over the quarter as inflation expectations rose sharply. So as a result, bond prices fell. And in paragraph 3.3, the chart there really shows the recovery in terms of world GDP over the past 12 months or so to the end of Q1 2021. And so really the outlook for the global economy, you know, is much improved, you know, relative to the position that we were in perhaps 12 months ago in the depths of lockdown and the coronavirus pandemic. So things certainly looking a lot more positive than they have been, you know, 6 to 9 months ago. Just moving on to look at fund strategy and how the assets are currently positioned. Table 2 on page 98 shows the position of the fund's assets at a more recent snapshot in mid-May, effectively showing you the position of the fund's assets at policy group level. So you can see a slight overweight to equities, underweights to real assets, non-gilt debt and to gilts, slight overweight to cash and an overweight to the diversified growth allocation. The main thing to note there is that for the 5 policy groups, you know, the current weights are well within the permitted ranges that are shown in the table there. And the diversified growth mandate has been identified for future disinvestment as other investment opportunities are identified. Turning then to fund performance, maybe best to go to the appendix, really to finish off there, just to show the performance of the fund over the quarter. We can see Falkirk, the 3-month performance there of 3.6%, ahead of the benchmark return over -1.3%. The longer term returns over 5 years and since inception are all strongly positive. at the 5-year mark, slightly below benchmark, but just over benchmark since inception. There's also the returns there for the individual managers. I'm not really going to go into them in any sort of detail just now. We'll maybe pick up on some of the managers when I go through the next item. So that was all I was going to say, and I'm happy to take any questions if there are any.
Thanks, Albert. Do you have any questions? No.
Convener,
Uh-huh.
I wonder if it might just be helpful linking or asking for a link to be made between Albert's comments there on the movement on gilts against the backcloth of what Scott was emphasising in the previous conversation.
Yeah.
Yes, I can certainly touch on that, and Scott and Bruce may want to come in as well. Yeah, so from time to time, I think it would be fair to say that all markets can exhibit some level of volatility. So in the very short term, you can have these moves in yields as market participants react to changing market dynamics. But that also then needs to be balanced against sort of the long-term position. So when you're in terms of the strategy piece, that's maybe more about thinking about, well, you change strategy now based on some assumption. And so really the way in which it links in would be around to continue to monitor what gilt yields do. And if gilt yields do continue to rise, then the funding level will benefit. And then we might expect to make changes to the allocation within the permitted ranges as and when the funding level improves. If you were to make those changes now before the funding level has improved, it would be sort of like counting your chickens before they're hatched. You would be looking to reduce your risk even though the benefit that you're hoping to come through hasn't actually been observed yet. So the decision to hold off from reducing risk now and to look to reduce risk further if the benefit comes through would seem to be the more prudent one. So that's really, the link is really between observing what's happening in the markets now and then adjusting the allocation as and when those improvements come through, but not before. And just to add that, so that movement in yields that you saw in the quarter, while it was substantial, it only really took gilt yields back to where they'd been maybe sort of 6 to 9 months ago. So they're still quite low. They're just not as low as they have been more recently. So.
Scott, do you want to add anything to that?
I would if I was unmuted, yes. So if I could just add that there is a delicate balancing act that the managers have to perform here, and that is avoiding the sell-off in gilts whilst it happens in isolation, but before rising bond yields begin to bring down the general kind of financial edifice. And no one really knows when rising bond yields turn from a general virtue into a general problem. But we employ, the team employ, what are called triggers, which compare levels of bond yields to asset markets, etc. And at regular points when trigger levels are hit, then the team will look and say, right, what do we think here? So triggers exist as a discipline for discussion and for assessment. It's a mistake to allow triggers to drive actions without any assessment of the context, but the team don't do that. But there is that balancing act between when rising bond yields turn from good to bad is a delicate one, but it's a significant one for the scheme. So there's no point, as I perhaps touched upon earlier, There's no point in waiting for higher bond yields if by the time they happen, you've lost half your equity value. But as you touched upon, Convener, no one knows what the future is. But there are lots of moving parts in this.
Thanks, Scott. Has anyone else got anything that they would like to ask or discuss? No? Bring us back to the recommendations. Has everyone had a chance to look through the recommendations? Yep. If there's no other questions, I'm happy to know. Agreed.
Agreed.
Thank you. Okay. We're moving on. I think is it Albert or Bruce is taking this next agenda item?
Yes, I was going to take the next item as well.
That's great. Thanks, Albert.
Convener. Thanks. So this next paper
Sorry,
just
Convener.
goes.
Convener, next item is excluding the public.
So, yeah.
Mr. Blackwood, sorry, I didn't hear that.
Item 7 is exclusion of public.
Oh, yep. Thank you. Thanks for reminding me. Just to let folks know, we're now moving into the private session of our committee this morning, and we'll be no longer live streaming as we go private.